Welcome and hello. Thank you all for joining in today. We have a very exciting company to talk about today. It's going to be Dropbox. Now, I've held Dropbox since the very beginning of 2021. That's when I opened up my first position, and this makes up about 11% of my portfolio currently. So really what this is, it's not this crazy, flashy new company. It's growing 100% a year. It's one of those value plays that I really do think is just people aren't paying attention to it because it's not the next big flashy company. So with that being said, we're going to dive into it today. The whole TLDR of this whole video, just so that way if you want to jump to the end or jump anywhere, there's going to be chapters down below based on what you're looking for. But the whole TLDR of this, around $16 to $17 is where I would continue to add to my position, but my cost basis currently is about $21 to $22. So I'm totally okay with that cost basis, especially given some of the strengths that we're going to be seeing here in terms of the, the equity of this company and what they're going to be doing with it and how they're going to be really giving back to the shareholders. So if that's something that interests you and some good value that interests you, make sure to stay tuned and hit that like and subscribe button. Let's dive into this. Now, what is Dropbox? Dropbox is the company that basically tries to integrate all of your, documenting needs online. So the whole idea, if you've used Google Drive, if you use a version of Microsoft Office, the 365 version or Box maybe, you probably have some sense of this cloud storage idea and what it actually is getting at. Now, where Dropbox fits into all this is really their target customers are the small to medium-sized businesses. Now, the enterprise, the freelancers, whatever it may be, that's really where I think a lot of this fits in. And they also have different product offerings besides just sort of their basic cloud storage. So the basic cloud storage, though, portion of their business really has a couple of different premium options. So you kind of have the free, you can have a couple of gigabytes worth of data to store your files and whatnot, and actually be able to use some of the functions. You have sort of your moderate to intermediate, level, and then you have your professional level, which is usually more so for companies, and then obviously they have enterprise solutions if that's something you're interested as a business, as a very large business. On top of that, they have something called DocSend, which is basically allows you to send documents, be able to see where it's at, things like NDAs or maybe other legal documents. You can see, when it's been sent, when it's been opened. You can track all the different analytics behind that, along with they recently acquired HelloSign within the last 2 years. HelloSign is really the DocuSign competitor. I believe it's second in terms of that sort of space. And really what it is it allows you to e-sign documents, because that's really becoming more and more common. As there's no point in, if you just need a partnership agreement or something signed and you don't want to have to fly all the way across the country, easily send it on HelloSign, get it signed. You can see exactly when it's signed, and then it'll save all of that data into your Dropbox. You'll be able to keep all of, not just the actual file and the signature itself, but along with the audit history in case anything comes up later on. You'll be able to actually track that back and be able to prove that it was signed and what time it was signed and who it was signed by. So that is really what their product offering is. Let's go into a little bit of breakout and continue on with our journey through this company. Now you can see in this screenshot, they make about half of their, sales revenue from the United States. They make the other half of their sales revenue from international. They operate within 180 countries. So you have a lot of different countries and a lot of different companies that are going to be getting into this. And the great thing is that as you see more and more growth over the years, you'll be able to see that international piece expand along with the United States. And I think that that's the better part. If they can get into those international spaces, into those international companies, or even just freelancers that are operating internationally, that'll be some great revenue over the next coming years. Because if you think about it, it's not as built out infrastructure wise, and there's some companies that can't have either the space, the server space, or they don't have the infrastructure to operate outside the United States. So seeing that they're operating in 180 different countries is a really good thing. Along with that, one thing I do want to know in terms of how they recognize revenue and incur costs, because I think that for some companies it's pretty obvious. In this case, I just want to mention it real quick. So when you sign up, you sign an annual deal, and what they do is they recognize that revenue over the course of, let's say it's an annual deal, each month they recognize that revenue. So rather than, hey, I just signed up an annual plan, I get all that revenue right at the beginning of the year, or whenever the beginning of the annual period would be, they recognize it over the course of 12 months. Along with that, they incur costs as needed or, as it's actually incurred. They don't really accrue the costs associated with those plans. If the costs incur, they incur, and that's how they put them in the net income statement. So that is something I really wanted to note before we continue with this, because I think it is something that is relevant for people who are just trying to understand how this business works. Now that you have a good idea of what the business looks like, let's hop right into the financials. Now, first things first, their top line revenue, their TTM or trailing 12 months, is about $2.2 billion. And that has been steadily growing over the last few years, but it's, the growth rate is decreasing year over year over year. So that's what I'm saying. If you're going to get into this, you need to understand why it's a value company and why it's not this crazy growth company. Now, one thing I also want to point out is that their profit margin is around 16% for 2021. One thing I do want to note, when COVID started, you look at 2020, and I'll pop up the chart here. When you look at 2020, their net profit was negative, technically speaking. That's because on a GAAP basis, they have to they have to recognize that they impaired some of their real estate. So what happened was they decided to go to a virtual first initiative, and they got rid of a lot of their real estate that they had, or really the leases and things that they had tied up with that in San Francisco when the pandemic started. So when you look at it, it's a one-time incurred cost, and obviously, it got paid and it got incurred. So it's not going to keep coming back. So that's why when you look at 2020, you got to understand that that's where it's going. But one thing I did want to note, their net profit margin was around 16%, and I imagine it'll be around the 16 to 20% mark as we see the company continue to grow. They get their costs under control and all those things. Now, their net profit margin, along with the 16%, they had a gross margin of almost 80%. I think as of Q1 2022, they broke that 80% mark with their quarter. So if we continue to see quarter over quarter, month or year over year, 80% gross margins, there's a lot of room for them to bring that down to the bottom line. I think that's what you're going to see over the next few years, is them actually getting those costs under control, and the management is very, very, very aware of what shareholders are looking for. Now, along with that, their current PE is around 22. I think I saw that their forward PE was around 15 to 16, depending on where you're looking. Their enterprise value to EBITDA was around 16, 17 when I was looking at this. And I think that another piece too was their cash right now. So in total of their, cash and short-term investments, their cash is about 450 million, 445 million. And then the remaining difference of that is all short-term investments. So think of things like treasuries and bonds and things like that. That's where they have a lot of their money tied up. So it's a lot of cash and short-term investments, or, really liquid items on their balance sheet that they can turn into either repurchases, business expenditures, or, acquisitions or things like that. So the other thing I wanted to mention was the debt that they have on their balance sheet and really what that all looks like. Now, the debt on their balance sheet, the current, total debt that they have on their balance sheet is roughly 1.3 billion. And a lot of that is really due to the fact that they took out convertible notes. And if you look here, the convertible notes interest rates really aren't a lot. And obviously they're convertible notes. That's like a big portion of why. And really, it's not going to be due until way later on from now. So maybe like 4 or 5 years out, and even more so, depending on what you're looking at. So that is something I wanted to note, because I do think that they do have a lot of debt, relatively speaking. It's almost equal to their cash. I think it's a little bit below it, or cash and short-term investments. But it is something I wanted to mention, because it's either going to dilute the shareholder at the end of this, or it's going to end up being bought back by the company at some point. So if you're paying attention to this, it is a lot of debt on the balance sheet in terms of what they needed to do with it. But I do think that the company is in a healthy spot in terms of their free cash flow, and you'll see that here once we get to the strength portion of this video. So I actually found an article from Allied Market Research, and this is someone that I've used in previous videos, but one of the things that I wanted to mention was where they thought. Now, in 2019, the market for cloud storage was $46 billion, and they were projecting this to go into 2027 to $222 billion. Now, from 2020 to about 2027, that's almost a 20 to 21% CAGR, so compounded annual growth rate, which honestly, if you think about the cloud storage game and how many people are in this right now, there's a lot of people in terms of competitors and things like that, and I'll mention that on later. But I just want to point out that, again, the rising tide lifts all boats. And you know, if you keep your market share where it is, and if you go after a certain target audience that no one else is really going for, think about like Google Drive and you know, Microsoft aren't necessarily going for the small guys. Not that it's not offered to them, but there's things that are, you want a little less, you want a little more simpler that might not be on those platforms for smaller enterprises. So that is also one thing I wanted to point out in terms of the industry. It's a lot of growth going forward. So it may be something else to look into within that same industry, whether or not it's an actual cloud storage like a Dropbox, or if there might be like an equipment or someone sort of like a picks and shovel tactic in terms of investing into this space. So moving on from the industry into the strengths, one thing I wanted to point out was their ARR, ARPU, and their paying users. Again, ARR is annual recurring revenue, ARPU is average revenue per user. So let's dive right into this and dive right into really the rest of the strengths that are in this business. So first things first is the ARR. This is again from 2021 or from 2019 to 2021. These are the year-end numbers. So in 2019, you had $1.8 billion, and that went up to $2.2 billion in 2021. Again, in 2019, for paying users, went from 14 million paying users to about 16.8 paying users. And then you had ARPU went from 123.07 to about 133.73. Now, the first strength that I really wanted to touch on was the ARR and ARPU, and as I showed you, that was for the year end, and I'm going to pop up some numbers here that are just sort of through March 31st, 2022, so Q1 2022, just so you can get an idea of where it kind of left off in the last quarter. But the thing is that when you're looking at the ARR, one of the key pieces of this business is that it continues to grow. And again, this is recurring revenue. So a lot of times what happens is you pay, you know, if you're paying your annual spot, you pay at the beginning of the year, but they just don't recognize it until the end of the year, until you know, they give you basically all the service that you're owed. So that is one thing in terms of their ARR, and why I think it'll keep growing is just the way that it's paid and the way that it's recognized. On top of that, people need these businesses. It's really sticky business, especially when you set up your whole entire enterprise on Dropbox. It makes it really easy once you get all your team members and things on there. And it's really hard for them to transition off of that. But going with that, the ARPU is also another thing, because that shows you sales per user in terms of revenue per user that they're getting and what the average really looks like. So if the average keeps climbing, that means that we're making more and more revenue per user that we have paying on this platform. And I do think that one of the key pieces of all of this is that you want that to continue to grow. Even when we get to sort of bigger numbers, you want that to continue to grow, because that means that we're still operating efficiently and we're not losing revenue per user that we keep adding. So the next strength that I wanted to touch on was actually the paying users. Speaking of the users, so they had around 700 million registered users, and of that, about 16.8 were actually paying users. So you can see the vast delta of paying users versus people who are actually just registered. And registered could just mean you signed up with a Gmail or email or whatever kind of account you wanted to do. You signed up, logged in, boom, registered user. Now, the whole thing that they're working on right now is actually converting those people into paying users. And the best thing about this really is the fact that they have an open ecosystem and they are able to work with different pieces of software. And this is really strength number 3, is the open ecosystem. So they have a ton of partners that'll pop up on the screen here. And I think that one of the key pieces in all this is that when you look at these partnerships, you're thinking, you know, why can't someone else do this? And a lot of times it's because they want to be able to control things on their platform. But the best part about Dropbox, you can edit a Google Doc on Dropbox. So a lot of times what ends up happening now is, because of the way they've set up their ecosystem and the whole platform, you actually have this thing where you don't just have to be tied down to one platform. So you don't just have to be a Google Drive. You don't just have to be a Microsoft 365 subscription user. You can actually use these in tandem. And let's say if you have a preference for using Dropbox over, you know, using something else, you can use this instead and use them together rather than having to pick one and say, oh man, I don't like this on Google Drive. I just wish Dropbox had, you know, some of the other Google Drive features. You can use them together. So I think that that will end up happening where there might be a feature on Dropbox that you want, or maybe HelloSend or DocSend or any sort of acquisition they make in the future, and you'll be able to actually, you know, complement different parts of your business. And that's also something else I want to mention too. You don't just have Dropbox, the platform, you also have HelloSign and DocSend. So let's say you have Google Drive, but you want to use HelloSign so you can, make sure that documents that are being signed are being tracked correctly and you can actually look into the audit reports and things like that from the document to make sure that it's been signed by the proper person, you can do so. So I think that as far as open ecosystem, this is something really the CEO has harped on a lot, is that it makes it better for the end user and it really helps them as a whole because they can create partnerships with different companies that really work together. Now, the fourth and final strength and thing that I really wanted to touch on was their free cash flow as well as their repurchases. It's mostly going to be more so about the repurchases. So first things first, they have about $700 million worth of free cash flow for 2021, and they estimate that they can hit, or their goal is that they'll be able to hit $1 billion in free cash flow per year by 2024. So if you look at today's numbers, let's say you just take the market cap, I think it's at 7.58, divide that by 700 million, you get about 10 to 11 price to free cash flow ratio. So if you grow the free cash flow over the next 2 years out to $1 billion, so you go from 700 million to $1 billion, let's say you just kept that 11 price to free cash flow ratio, you'll have an $11 billion value in terms of the market cap of the company. So that's about 45% from where it is today. And that's something that when I was doing my initial research, I was surprised. On top of that, there's a lot of repurchasing going on. So right now they have about $1.2 billion worth of repurchasing still available. They did authorize a couple different iterations of repurchases, and they've kind of been adding into these repurchases throughout this whole entire time period. So along with the strong free cash flow, they're using that free cash flow a lot to repurchase companies and repurchase stock, really. And I think that one thing that I wanted to mention is it's at $1.2 billion. The market cap is 7.58 billion. So we're about 15% of the market cap currently is authorized to be repurchased. Now, obviously the company has come down from the time period, 6 months ago. So for them to be buying at lower and lower prices, that's exactly what you want to see because you want more shares to be bought at lower prices. You don't want someone to be buying back shares at insane pricing. That doesn't make any sense. So I really do think that the share repurchases, along with just the general free cash flow growth that we've been seeing, and as I mentioned with the gross margin, the profit margin, just the expansion of those margins has been great. So if you can continue and really believe that this company can continue this growth, I think that there's a lot of opportunity here in terms of a risk to reward play and really what the understanding of it. I think a big portion of it will come down to the valuation, and we'll talk about that more when we get to the DCF. But moving on, I want to touch on some of the weaknesses and things that I really see as risks because in a space like this that is very competitive, there are quite a few. Now, the first weakness is really the competition. And again, there's competition. There's going to be competition in the cloud storage space. I can't imagine there won't be because, again, there's a lot of big players, there's a lot of small players, and really the big thing is who is going to take the top and then what is going to be left after that. So, you have companies like Google, Microsoft, and Amazon that all have cloud storage in one way or another. Obviously, AWS isn't so much focused in the same realm that Dropbox really is, but again, it's cloud storage, so if people can put their servers on AWS, why would they need to use Dropbox? So that's something I want to pay attention to, is sort of the digital piece of the storage of Dropbox and how they can remain competitive there. So as far as their competition and things go, again, if they have the bigger players like I had just mentioned from the FANG companies, or if you have partnerships like VMware and Adobe all have partnerships with Dropbox, if something happens to one of those companies, it could possibly hurt Dropbox in the end. And if you think about, let's say a freelancer is using Dropbox, people send assets back and forth to someone. If they no longer need to use Adobe, they're not going to need Dropbox anymore. If something happens to Adobe and they can't use Adobe anymore, and they're not going to use Dropbox anymore either. So it is something that I want to note that competition-wise, you want to make sure you pay attention to that and understand where in the hierarchy Dropbox really fits. Because again, I don't think that Dropbox, the actual storage platform of Dropbox is going to, overtake Google Drive or Microsoft 365 in the near future at all. I do think that they are a competitor, obviously, but I think that their target audience is probably different. So that is something I did want to mention. Now, the next thing I also wanted to mention, really, it comes down to the cybersecurity risk of using so much data in their storage. So this is going to be a risk to probably most companies at this point that are getting into technology or that are involved in technology and data in one way or another. But the cybersecurity risk really can't be understated with a company like Dropbox. Because the thing is when me, a user, or client, or customer, or enterprise really, trust Dropbox with my data, I trust them to keep it safe. If for some reason there's some sort of hack or some sort of cybersecurity breach that is really, really big, if it affects me or even it doesn't affect me, I'm going to be more wary and go to a different company. And honestly, I probably would tell my friends as well, like, hey, this happened to me or this happened to someone else I know. I'd stay away from Dropbox and go to a different company. Obviously, cybersecurity risk can't be, it's hard to take into an account what that really looks like because the cybersecurity threats are always ongoing. But I do think it's something that you should know about, or at least I should mention, because if something does happen, the reputation and brand alone could get hurt pretty badly. So it is something you want to pay attention to in terms of understanding where they are in cybersecurity wise. And the thing is too, is that because they partner with so many different platforms, the third party risk of just one person having their Dropbox hacked into, because let's say you opened your account to something that you probably shouldn't have, that is also a risk as well. So the cybersecurity risk, along with any sort of data regulation, was the third weakness that I had on here. So if we have any sort of policies or anything come out from the governments as far as data regulation goes, especially since again they operate within 180 countries, so a lot of different countries have different rules and different things. It could just mean that we will incur more costs trying to deal with this. So let's say if Europe comes out with you have to have a certain storage capacity or something within Europe to be able to keep this data. Anything like that where it's going to add more rules and more things to follow within handling data and making sure data is secure, that'll be an issue as well, because it'll just incur more cost to keep that same exact amount of data, same exact amount of sales worth of data secure. So that is something I wanted to mention. But with that being said, let's hop right on over into the DCF. Now, as I had mentioned, the DCF is probably one of my favorite parts of this whole entire thing. And the thing is, my DCF doesn't take into account the stock repurchase. It doesn't take into account really the $1 billion target set out by management. So with that being said, let's hop on right over to it. So obviously you can see I got the current outstanding shares, revenue, current free cash flow, along with the current net income. You can see here I got the market cap and all those things and the share price. Again, the fair value that I have on this is around $19 to $20 in terms of my calculation. Now to see down below what the calculation really looks like, on the low end, so in the worst case scenario, I got 5% a year revenue growth for the next 7 years. On the high end, I got 10%. I think it'll probably be between 5 to 7% unless they get some sort of acquisition or thing or something related to that in the mix. But as far as their margins go, I got a 12% on the low end and then 16% on the high end, along with free cash flow margin. I got 15% to 20%, and then the ratios for both is 17.5 to 22.5. Now I use a 12.5% discount rate. That's going to be what my required rate of return. And below you can obviously see the fair value is $19.53. So that's where I'm at with this. Again, my cost basis is $21.98. If this goes, you can see down below, I have margin of safety calculated out as well. If this goes down, honestly, to $16 to $18, $16 to $17, somewhere around there, I'll probably keep adding. I don't want to make this a huge, more huge position than it already really is at 11% of my portfolio. I don't want to make this too big, but I do think that if you look up here, the worst case scenario on the net income side, you come out to $11.14 a share, so about half from where we are today. On the top end for the free cash flow side, so the best case scenario, you got about $30. So again, I think that as far as the opportunity and risk to reward, I think a lot of it's going to hinge, for me at least, on whether or not they can hit that $1 billion free cash flow mark, as well as whether or not they can actually grow this business and get the stock repurchases as a factor. 15% of their current market cap is quite a lot of stock to be buying, and I think they're going to try to see if they can do it within the year. So we'll see if it spans multiple years or if it's just this year, and where that actually moves the stock price, because the valuation, I don't think this company is overvalued. I think my 21.98, if I weren't, if I didn't already have the position, I probably would have kept adding around 22. I think it hit around 22, 21 as of making this video. So I probably would have kept adding or started my position around 21. This is bought all the way down. I started my position a year ago with 21.98 as my cost basis. So with that being said, my final thoughts on this is really, if you like the opportunity, if you think it's good, if you like the steady business, look into the company, see what you think, do your due diligence. Obviously, I do think that there's an opportunity here with the stock repurchase along with the free cash flow, that they have been growing steadily, and obviously they've become profitable over the last 2 years. I continue to see that happening, and Drew Houston, the CEO, really does see a lot of opportunity, sees a lower churn rate, as well as just some growth and different initiatives that they're taking to grow the business and convert 700 million registered users and try to get at least a portion of those people into paying users. So with that being said, thank you all so much for joining. Happy investing. Have a great day. Bye.